Hello creatives! In this video, I'll share with you 10 personal finance rules school doesn't teach you to help you make sound financial decisions and get ahead of your peers. Personal finance concepts like budgeting and saving, or investments and retirement planning, are things everyone needs to know before leaving school. It's so unfortunate that schools don't teach them, and you can't imagine the consequences. Nowadays, we have graduates who can't budget their money, let alone save or invest. Others are slaves of borrowing. But why is personal finance not taught at school? After detailed research and some asking around, I arrived at 3 chief explanations. Most teachers don't understand personal finance, so they can't teach what they don't know, which makes sense. These teachers who understand personal finance might not be sure if they can do it, given the school curriculum limits them. They see that it's essential that they first teach what's on the syllabus. Others assume it's the parents' responsibility to do it, while the parents think it's the teachers. So what should you do? Given that personal finance is all about money and money touches almost everything in life, you have to learn about it, be it out of school. That takes time and effort, but it's doable. As Robert Kiyosaki puts it, we are not taught financial literacy in school. It takes a lot of work and time to change your thinking and to become financially literate. How about I help you get started? I'll take you through a few personal finance rules you should have learned in school to help you manage your finances better. Watch out for rule number 6. It's what most people wouldn't tell you, but could be the formula to becoming rich and attaining your financial freedom. But before then, if you are new here, consider subscribing to this channel to continue receiving great videos like this one. Don't forget to hit that notification bell so you get informed every time I publish a life-changing video. Here we go. Number 1. Budgeting is a necessity. Most schools leave this duty to parents. Those who teach it do it briefly, so they don't get into the details of how to do it. I was lucky enough to be taught by my folks how to budget while I was still in school, and I'll share with you what I learned. For starters, I came to understand that budgeting is vital for all, regardless of how much you make. My parents would ask me to first know how much I have and then split it accordingly. However, I've learned different budgeting formulas over the years. The simplest of all is the 50-30-20 rule. This budgeting rule, attributed to Senator Elizabeth Warren, dictates that you spend 50% of your after-tax on needs, 30% on wants, and 20% on savings plus loan repayments. The takeaway: use the 50-30-20 rule accordingly to manage your after-tax income properly. Just like Dave Ramsey advises, you must gain control over your money, or the lack of it will forever control you. Number 2. Cash flow tracking. Setting up a monthly budget is not enough when it comes to managing your finances. You have to monitor your cash flow. In particular, you must know your monthly income, your monthly expenses, your balance for the month, the amount to save or invest. The truth is that monitoring all that information is not easy. You can't always record every coin that you spend. That's why you need a tool that can do all the legwork. My favorite cash flow trackers are Personal Capital and Mint. These fantastic tools are free, and as a result, you have no reason not to use them. You can sign up through the links in the description below. The takeaway: use cash flow trackers to monitor your finances. You won't learn about this in school, but it's a priceless financial lesson. Number 3. The 20% saving rule. Saving is a culture that you have to nurture. It's not easy to save. That's why Jack Benny's advises you, try to save something while your salary is small. It's impossible to save after you begin to earn more. There are different saving techniques, but I'll second the famous 50-30-20 rule that I covered earlier on. In this budgeting rule, you should save 20% of your after-tax income. Consider saving it in a high-yield savings account to see your money grow. If you save consistently for a few years, then you can afford the car or house you've always wanted. You can also pay for college, start a business, take up investment, or do just about anything. The takeaway: learn to reroute 20% of your after-tax income into a savings account. That allows you to pay yourself first, a personal finance principle that prioritizes saving over spending. Number 4. Setting up an emergency fund. The school might have left this rule for your parents, but perhaps your parents didn't recognize that they have to teach you about it. Well, I'm here to tell you that you need an emergency fund. It's a bank account that you set up to save money for unplanned events. These events could be an illness, a collapsed roof, a car breaking down, a job loss, or any other unprecedented event that demands money. Most finance experts recommend that you deposit at least $1,000 in an emergency account. That's a great starting point, but it doesn't have to be the limit. In my view, you need to set aside an amount that equals your 6-month monthly expenditure. The takeaway: save at least $1,000 as a starter fund and then aim for an equivalent of your 6-month monthly expenditure for your emergency account. Number 5. Your tax obligations. It's argued that besides death, tax is the other thing you cannot avoid. Yes, you might postpone or even evade paying it for some time, but once Uncle Sam catches up with you, then you won't have anywhere to run. The best thing you can do is to understand your tax obligations and fulfill them. You need to understand that you can make money as an employee, self-employed, an investor, or a business owner. In all 4 groups, only employees have zero control over their taxes. That's because the deduction is made by the time they receive their paycheck. If you belong to any other of the 3 groups, you need to consult a tax professional to inform you about your obligations to Uncle Sam. The takeaway: learn about your tax obligations and comply with them. Number 6. The power of compound interest. If you invest your money in an interest-yielding investment in your 20s, the chances are that you'll be financially independent or even a millionaire in your 40s. Now imagine this: if you make an initial deposit of $1,000 and $1,400 monthly contribution in an investment fund that pays 10% annual returns compounded monthly, you'll have made $1,079,459 in 20 years. That's thanks to the power of compound interest. And, like Albert Einstein once said, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. So, what exactly is compound interest? Compound interest is the interest you get on a deposit or loan. In other words, it's the result of reinvesting an interest earned. Others say that compound interest is an interest above an interest. Compound interest allows you to amass wealth that compounds over the years. With it, your money grows fast and you earn returns on your principal and the interest. Some good investment choices that earn compound interest include stocks, bonds, REITs, certificates of deposit, mutual funds, and high-interest savings accounts. The takeaway: search for the best interest compounding investments to put your money into and earn compound interest. Number 7. Using credit cards. Credit cards are not as bad as most people perceive them to be. It's just when you borrow to pay for things that don't make financial sense that credit cards become a problem. For example, going for a huge party and then using your credit card to pay the bills is not financial literacy. Remember, a batch credit card flattens a wallet before it thins it, according to Eva SR. On a positive note though, a credit card can help you build your credit score if you are prompt with your payments. Remember, you'll need to own a house or a car someday, and you may require a loan to finance the purchase. That's possible when you have a good credit record, which I mentioned is achievable with good credit card usage. Nonetheless, you should do your best to avoid credit card purchases. Work hard to generate more income and use cash for your purchases. The takeaway: learn to use credit cards to build your credit record and avoid accumulating debts as much as possible. Number 8. Student loans are not a must. Most people find it hard to make meaningful investments when they're at a new job or a new business because they struggle to pay their student loans. Some owe as much as $100,000, which is just outrageous. Your professor will not tell you not to procure a student loan, as that may appear like telling you to not continue with your studies. So, it's up to you to find a way to avoid the loan or reduce it without having to drop out of school. Consider getting a part-time job. You can be a waiter, a delivery guy, a home tutor, or a babysitter. It doesn't matter what you do as long as it's legal and it brings in money. The other approach is to attend a cheaper college if that works for you. The takeaway: find a way to avoid accumulating student loans even if it means getting a job. Number 9. Protecting your wealth. We've talked about preparing for emergencies with an emergency fund, but some risks need more advanced preparation. For example, a house fire requires home insurance, while a car wreck requires auto insurance. And when it comes to accidents and serious diseases, taking up life insurance is advisable, especially for the sake of your family. So I recommend that you at least take up these 3 insurance policies. You can also throw in a business insurance policy if you run a business. That'll allow you to protect your wealth and source of income. The takeaway: follow Warren Buffett's words of advice. Rule number 1: never lose money. Rule number 2: never forget rule number 1. Number 10. Protecting your health. I believe that the best gift you can give your family and the world is a healthy you. These words by evangelist Joyce Meyer inspire me to look after my health first before my wealth. Yes, you might have learned a few things about looking after your health, but not enough to relate health with wealth. Do you know that most billionaires have a healthy lifestyle? They work out, they eat well, and they de-stress often. Well, that's the case with Virgin founder Richard Branson, Facebook founder Mark Zuckerberg, talk show queen Oprah Winfrey, Mavericks owner Mark Cuban, to name a few. The takeaway: observe a healthy lifestyle, as the first wealth is health, according to Ralph Waldo. In conclusion, schools don't have to teach you everything about personal finance. You can learn by yourself. I've shared 10 personal finance rules that will improve your financial literacy and help you manage your finances better. I know this video was exciting and you loved it. Also,